Last month, a woman in Ohio sat down at a closing table to sign a mortgage. It was a 30-year fixed loan at 6.6%. And she asked the loan officer one simple question: who decided 6.6? He gave her a corporate smile and said, "That's just where rates are right now. That's not an answer. That's a shrug with a lanyard." Because that number wasn't picked by her bank. It wasn't picked by the Fed either. It was set by a market almost nobody has ever looked at. That market is worth about $145 trillion, bigger than every stock market on Earth combined, and it runs everything. It decides her mortgage, your car loan, your landlord's next rent hike, and whether your company can afford payroll. It also decides whether you're safe. Retirement fund quietly loses 17% of its value in a single year. This isn't about some boring thing rich people buy. It's the invisible machine that prices your entire life. My name is Nicole, and I've spent way too much time reading about a market with zero personality and a huge body count. By the end of this video, you'll understand money better than most people walking around with finance degrees. Let's start simple, because everyone overcomplicates this. A bond is just an IOU. Nothing more, nothing less. A government, a company, or occasionally a city that wants a stadium it doesn't need borrows money from. Investors instead of a bank. You hand over $1,000, and in return they promise you two things: a fixed yearly interest payment called a coupon, and your full $1,000 back on a specific future date, which is called the bond's maturity. When the US government runs a deficit, which it always does, it sells treasuries to cover the gap. When Apple wants cheap cash, it sells corporate bonds. When shakier companies borrow, those bonds are called junk or high yield. Here's the part 90% of people get wrong, and it's the single most important idea in this whole video. Say you buy a $1,000 bond paying 2%. So you collect $20 a year. Boring, but fine. A year later, rates rise, and brand new bonds from the same borrower now pay 5% or $50 a year. So who wants to buy your old bond now? The one still paying just $20 a year? Nobody, unless you drop the price. Because your bond is now the financial equivalent of a used phone. It still works exactly as promised, but nobody pays full price for it once something newer pays more. You cut the price until that fixed $20 payment equals roughly 5% for whoever buys it from you. That means selling your $1,000, but for somewhere in the 700s. A real loss on a safe investment. Here's the rule: tattoo it somewhere. When interest rates rise, existing bond prices fall. And when rates fall, bond prices rise. They sit on opposite ends of one lever. And every disaster in this video is just that rule operating at scale. The first place this rule shows up is a single number that quietly runs your entire financial life. If aliens landed and asked to see the one number controlling Earth's economy, you'd show them the 10-year Treasury yield. Right now, it's sitting around 4.5%. And it matters even if you've never bought a bond in your life. When a bank writes your mortgage, it doesn't invent a rate. It starts with the 10-year Treasury yield. Why would a bank lend to a random person for 30 years when it could lend to the government risk-free? It wouldn't, unless you pay more. So the bank adds roughly 2 points for the risk of lending to you. 10-year at 4.5%. Mortgage at 6.6%. That's not a coincidence. It's the biggest single input in the formula. In early 2021, the 10-year sat near 1%, and mortgage hit 2.65%, the lowest rate ever recorded. People borrowed like the money was expiring, and home prices jumped 19% in 1 year against a 4% historical average. Then the 10-year yield ripped higher. Mortgages crossed 8% by late 2023, and housing basically froze mid-motion. The bank didn't do that to buyers. The bond market did, and it doesn't stop at houses. Car loans, credit cards, student loan refinancing, and even the rate your city pays to build a school, all priced off treasuries. When yields rise, every borrower in the country gets hit with the same rate increase at the exact same time. Companies that loaded up on cheap 3% debt in 2021 suddenly faced refinancing at 7% a few years later. When your interest bill doubles, you don't post about it, you cut costs. And cutting costs often means layoffs. A real chunk of 2023 and 2024 job losses weren't about the economy. They were the bond market repricing everyone's debt. The bond market also predicts recessions better than almost every economist alive, using something called the yield curve. Normally, lending for 10 years pays more than lending for 2, since a longer wait deserves a bigger reward. Occasionally, that flips, and short-term bonds pay more than long-term ones, which is called an inverted yield curve. It means investors are so nervous about the near future that they're stampeding into long-term safety instead. Fed researchers checked the record, and that signal has correctly called every U.S. recession since 1955, with one false alarm, 949, plus a single mulligan in the 60s, a hit rate your horoscope could only dream of. Strategist James Carville once joked he'd rather be reincarnated as the bond market than as the president or the Pope. He said the bond market can intimidate everybody, and soon you'll see it intimidate an entire country into firing its leader. But first, let's demolish the biggest lie in personal finance: the idea that stocks are risky and bonds are safe. For decades, every advisor pushed 60% stocks for growth and 40% bonds as your seatbelt. And then 2020 happened. The Fed jacked rates from near zero to over 4% in 9 months to fight inflation. And the seatbelt strangled everyone. Remember the rule: rates up, bond prices down. So the broadest U.S. bond index fell 13% that year. That was its worst year on record going back to 1976. And long-term treasuries got absolutely obliterated too. Long-dated zero-coupon treasuries lost 39.2% in 2022. The worst year for those bonds going back to 1,754. Not 1954, 1,754. Back when there were still 13 colonies and America hadn't even been invented yet. The classic 60/40ths portfolio lost about 17% because for the first time since 1974, bonds didn't cushion the stock crash. Millions of retirees opened their statements and found the safe part of their portfolio was the part bleeding hardest. So were they lied to? Sort of, because bonds only protect you from one risk: the borrower not paying you back. The U.S. government will always pay you back. But 2 other risks hide in the fine print of every bond. Inflation quietly shrinks what those fixed payments can actually buy over time, no matter how reliably they arrive. And the big one, interest rate risk, is everything we just walked through with the 2022 crash. There's a number that measures exactly how exposed your bonds are to that risk, and it's called duration. Duration tells you how much your bond drops in value for every 1-point rise in interest rates. A fund with a duration of 6 loses about 6% when rates rise a single point. Nothing more. A long-term treasury fund with a duration of 17 loses about 17% for that same 1-point move. In 2022, rates rose more than 4 points. So Grandma's Safe Bond Fund suddenly moved like a tech stock. Except it had none of the upside and none of the fun that comes with owning a tech stock. This exact same rule, rates up, prices down, then started taking down bigger and bigger targets one by one. First a bank, then an entire country. So watch how the same simple math brought down each domino. Domino 1, Silicon Valley Bank, March 2023, which took in a flood of deposits during the tech boom. It parked over $91 billion of those deposits into long-term bonds with an average duration around 6 years. Then rates spiked, and by the rule you now know, those bonds silently lost over $15 billion in value. SVB wasn't gambling on crypto or meme stocks. It bought the most boring assets in existence at the worst time, when it sold part of the portfolio at a $1.8 billion loss and asked investors for fresh cash. Depositors panicked. The 16th largest bank in America went from fine to seized by regulators in roughly 48 hours flat. Domino 2, the United Kingdom, September 2022. When new Prime Minister Liz Truss announced £45 billion of unfunded tax cuts, the bond market looked at the math and said no, dumping UK government bonds hard and fast. 30-year yields spiked more than a full percentage point in 3 days, detonating leverage inside British pension funds. Those funds were forced to sell more bonds to raise cash, which pushed yields even higher. A full doom loop. the Bank of England launched emergency bond buying, later admitting some pension funds were hours away from collapse. A British tabloid live-streamed ahead of lettuce next to Truss's photo, asking which would last longer. The lettuce one. She resigned after 45 days, the shortest premiership in British history, fired essentially by the bond market itself. Domino 3, the small one that says everything, Austria, which in 2020 sold a 100-year bond maturing in 2120. That bond paid a coupon of just 0.85%, and investors bought it eagerly, which sounds strange at first. At the time, roughly $18 trillion of bonds worldwide had negative yields, meaning investors paid governments to hold their money. Next to that, Austria's 0.85% looked like a luxury deal, so demand for the bond was strong. Then rates normalized worldwide. That negative yield pile evaporated, and the Century bond lost roughly 75% of its peak value. One rule brought down a portfolio, a bank, a pension system, and finally an entire country's government, all the same way. So you'd think the biggest borrower on earth, the US government, would be playing it extra careful right now. Its current tab sits around $39 trillion. But here's the one number that actually matters more than that total. This year, the US will spend over $1 trillion just on interest, not paying down debt, just the minimum payment. That's more than the entire defense budget, meaning America now spends more servicing old debt than on its military. Interest is now the second biggest line in the federal budget, behind only Social Security, and climbing fast. In May 2025, Moody's, the last major agency still rating America perfectly, downgraded the US for the first time in a century. Debt sits near 100% of GDP. Deficits run near 6% of GDP. And the customer base is getting picky. Foreign investors held over half of US Treasuries back in 2008. Today, that share has shrunk to around 30%. China's holdings are the lowest since 2008. So Washington needs to borrow more while its best customers walk away. What does any business do when demand softens? It offers a better deal. And in bonds, that means higher yields. In April 2025, after a chaotic tariff announcement, investors dumped treasuries hard and yields spiked within days. The administration paused the tariffs soon after, with the president admitting the bond market was getting a little queasy. Government policy reversed in under a week, not because of Congress or voters, but because of bond traders. So why should an ordinary person care about any of this? Because your mortgage is the 10-year Treasury plus 2. Every dollar of new debt, every downgrade. Every nervous foreign investor puts a thumb on the scale pricing your house. The government's credit card bill quietly becomes your interest rate, which raises the only question that actually matters here. First, stop donating money to your bank, since the average savings account pays about 0.5% interest. Meanwhile, 3-month Treasury bills pay around 3.7%, and money market funds pay around 4%. Same safety, way more return. Second, know the difference between a bond and a bond fund, because that distinction hurt millions of people in 2022. An individual Treasury held to maturity guarantees, every payment plus full principal back, no matter what rates do. A bond fund never matures. It's repriced daily. So rising rates show up as losses right on your statement. Third, check your fund's duration number on its fact sheet, since it's the most honest risk label you'll find. Short duration means small swings. Long duration means you're betting on interest rates whether you meant to or not. Fourth, if inflation worries you, the government sells insurance for it through Series 1 savings bonds, currently paying about 4.3%. Back in 2022, those bonds paid 9.62%. And briefly became the most exciting financial product in the entire country. Fifth, watch the 10-year Treasury yield. It takes 5 seconds and tells you where mortgage and loans are headed. When it climbs, borrowing gets more expensive everywhere at once. When it falls hard, markets are usually bracing for trouble. You've been part of the bond market your entire adult life, through every mortgage payment and every 401k stable fund. You just never got handed the rule book. And now you know the one rule everything runs on: rates up, prices down.